Hello everyone, and welcome back to Collin Investing, your go-to channel for navigating the complexities of finance and investment. This week we're diving deep into a comprehensive analysis of market trends, highlighting key indicators, and exploring some proven investment strategies. We'll unpack recent volatility, examine emerging economic concerns, and, of course, look ahead to what you should be watching in the coming week. We'll also touch upon recent developments with Trump, Musk, and provide some valuable takeaways from the legendary Warren Buffett. So, let's get started. Kicking off our market recap, let's address the elephant in the room. Volatility. The S&P 500 had a bit of a roller coaster week. We saw some impressive highs early on, only to see a significant dip in the later days. Now what's driving this? Two main factors are at play. First, we had Walmart's earnings report, and second, the ever-present concerns around tariffs resurfaced. I'm sure you noticed that. Walmart, a bellwether for consumer spending, specifically voiced concerns about inflation starting to bite, and that's impacting how much people are willing to spend. You see, that's a direct hit to the economy. It's crucial to remember that the ripples from a giant like Walmart can spread quickly. Imagine that one of the biggest U.S. consumer companies is showing concerns about the economy. Building on those concerns about consumer spending, the broader economic picture also showed some warning signs in February. We saw a significant drop in consumer confidence, and it's not just about how people are feeling, it is how people are acting. JP Morgan strategists, for instance, didn't mince words. They issued direct warnings about potential economic risks stemming from new policies. And yes, tariffs were front and center in their analysis. I think their concerns are very valid. In my years of analyzing the financial market, I seldom see any cases where tariffs truly brought advantages. Furthermore, consider this. S&P Global's data revealed that U.S. business activity in February was, to put it mildly, sluggish, showing minimal growth. This is concerning. We are seeing some impacts down the supply chain. So what does this all mean? These factors combined paint a picture of a potentially fragile economic landscape. So with all of this economic uncertainty as a backdrop, what should we be focusing on in the coming week? Well, the spotlight is squarely on one key data point, the U.S. Core PCE Price Index. This is the Fed's preferred inflation gauge, and it's going to be hugely influential. The market right now is anticipating or perhaps hoping for a decrease in the core PCE. Now, why is that so important? Because if we do see that decrease, it could lend some much-needed support to the idea that the Fed might actually start cutting interest rates sooner rather than later. But that's not the whole story. We also have other important data releases coming our way, including new home sales, which is always a good indicator of economic health, consumer confidence figures, which, let's be honest, haven't been looking too rosy lately, and finally, the fourth quarter 2024 GDP revision. Remember that any significant revisions there could definitely shake things up. So, plenty to keep an eye on, and each of these data points could be a major catalyst for market movement. But the data releases aren't the only thing on the agenda. We also have a lineup of Fed officials scheduled to speak, including Fed Vice Chair Barr. Now, given the current climate and especially in light of the recent inflation data, I think you can anticipate a consistent theme. Caution. They'll likely be hammering home the message of ongoing uncertainty and critically stressing the need for further evidence that inflation is genuinely coming down before they even consider loosening their grip. Don't expect any dovish surprises here. I think this is a correct approach. As a matter of fact, most economists are now predicting that the Fed won't be cutting rates again until at least July. So, the message is clear. Patience and a close watch on the incoming data are the orders of the day. Turning from policy to earnings, all eyes are going to be on NVIDIA's upcoming report. And let's be clear, this isn't just any earnings report. This is a major market-moving event. Why? Because NVIDIA is effectively the poster child for the entire AI revolution, and their numbers will tell us a lot about the real-world trajectory of this technology. We have to pay attention to this. So, what are the key things to watch? First, of course, is AI data center revenue growth. We need to see if the explosive demand we've been hearing about is actually translating into cold, hard cash. Second, we'll be looking for any updates on the Blackwell GP200. Any delays or advancements there could have significant ripple effects across the industry. And finally, and this is crucial, we need to hear NVIDIA's outlook on AI application deployment. How quickly are businesses actually using this technology? That's the key to sustained growth. Not just for NVIDIA, but for the entire AI sector. Remember, it needs to turn into real profit. Now, the stakes are high. Morgan Stanley, for example, is predicting a potential 3 to 15% stock price increase if NVIDIA's revenue beats expectations. But, and this is a big but, the flip side is also true. A miss could trigger a sharp sell-off, so brace yourselves for potential volatility. This is one report you absolutely cannot afford to ignore. Now, shifting gears from the corporate world to the political arena, we've got some significant developments involving Trump and Musk that are directly impacting the financial landscape. And that's where these two powerhouses come in, making waves with their joint efforts to, as they put it, streamline government spending and personnel. What exactly does that mean? We are talking about reducing inefficiency here. Well, it started with a rather unconventional approach. Federal employees received emails requesting detailed summaries of their recent work. This in itself isn't too unusual. Many companies do weekly reports. I have seen a lot of companies, even big tech, are doing so. However, the kicker here was the stipulation that none or what would be interpreted as a formal resignation. Yes, you heard that right. Consider a situation where you are in a long-term project and don't want to respond to the email. This is a sudden impact to families and individuals. Needless to say, this caused quite a stir, and understandably so. So much so that multiple government departments, including heavyweights like the Department of Defense and the FBI, actually advised their employees not to respond to these emails. It is truly a chaos. It's a clear clash of management styles and a bold, if controversial, move that has the potential to significantly reshape the federal workforce, for better or worse. We will see how things develop, and this confrontational approach isn't just limited to personnel. Building on the previous discussion, Trump has also signed a memo that essentially paves the way for imposing tariffs on countries that have digital service taxes targeting major U.S. tech companies. We are talking about big names like Google, Facebook, Apple, and Amazon. Now, this isn't entirely new. These digital service taxes have been a bone of contention for years. Several countries, including Canada, France, and the UK, have implemented them, arguing that these tech giants should pay taxes where they generate revenue, not just where they're headquartered. But the White House's stance is crystal clear. They believe that only the U.S. should have the right to tax American companies. It is a reasonable and understandable claim. The potential consequence here, and this is where it gets tricky, is a wave of retaliatory tariffs. It is like a trade war. This could escalate quickly, impacting global trade flows and potentially adding further fuel to the inflationary fire. So, we need to see how things develop in the future. This brings us to a critical question: how this political landscape is interacting with the markets. The answer, in short, is volatility. We're seeing a market that's incredibly reactive, driven by the constant flow of instant news, tweets, and policy announcements. It's almost like a constant whiplash, and that's creating a very challenging environment for investors. Here's the thing about tariffs, and this is particularly relevant with Trump's approach. It's not always a set-in-stone policy, even if tariffs are reimposed. Here is always the possibility, and perhaps even the likelihood, of negotiations, concessions, and ultimately reversals. Remember, political decisions can be heavily affected by the negotiation. He might give up on some of the ideas to exchange for other benefits. This inherent unpredictability makes it exceedingly difficult to make any kind of long-term, or even short-term, investment deals under the current circumstances. We are in a period of wait and see, where careful analysis and a very nimble approach are absolutely essential. Now let's shift our focus to a true legend in the investing world, Warren Buffett. And as always, Berkshire Hathaway's latest performance gives us plenty to discuss. The numbers are frankly astonishing in the fourth quarter. Their operating profits surged by a massive 71%. I seldom see a company at this scale that can grow in this rate. Let that sink in for a moment. That's a testament to the enduring power of their diversified business model. But here's the even more interesting part. Berkshire is now sitting on a record-breaking mountain of cash, $334.2 billion to be exact. That's an absolutely staggering figure. Now, what does this tell us? One important aspect is the potential challenge in the future. It's like a coiled spring ready to be deployed. In the future, there will be great opportunities to buy. In his annual letter, Buffett made it very clear. He remains committed to long-term investment, primarily in stocks, and most importantly, primarily in U.S. stocks. He's doubling down on this core belief in the American economy, despite, as we'll discuss, some very serious concerns he raised. But that's not the whole story, because amidst this celebration of past success, Buffett issued a stark and frankly quite sobering warning. He spoke directly about the dangers of financial stupidity and, crucially, the very real potential for paper money to lose its value. Imagine that all your assets suddenly diminish. This isn't some abstract theoretical concept. He pointedly referenced historical instances, Moments in time where even seemingly stable countries, including the United States, have teetered on the brink of currency crises. It's a chilling reminder that nothing is guaranteed, and complacency can be incredibly dangerous. And he emphasized a critical point that many investors overlook. Fixed coupon bonds, often seen as a safe haven, offer absolutely no protection in a scenario where currency becomes out of control. It's a powerful message, and one that echoes the importance of diversification, vigilance, and a deep understanding of the underlying forces shaping the financial world. It is a reality check for all investors. And that's where Buffett's long and incredibly successful history comes into even sharper focus. This year marks a truly significant milestone, the 60th anniversary of Warren Buffett taking the reins at Berkshire Hathaway. Think about that, 6 decades of consistent value creation. We are talking about an outstanding, almost unbelievable history. In his letter, he took a moment, and rightfully so, to reflect on this journey, and he highlighted 2 key pillars of Berkshire's success. First, the substantial contribution to tax. Second, the sheer performance delivered to shareholders, the impressive returns that have made so many investors significantly wealthier. And yet, even with all that history, all that success, Buffett remains deeply rooted in his core belief, and he explicitly said, the success can't be without US. He reiterated his unwavering confidence in the long-term prospects of the United States. He sees Berkshire's triumphs as inextricably linked to the dynamism and resilience of the American economy. It is a powerful message of enduring optimism, but always tempered by his characteristic prudence and a keen awareness of the risks that lie ahead, as he mentioned in his warnings. With that in mind, let's turn our attention to something many of you are likely anticipating, the annual Berkshire Hathaway shareholder meeting. Mark your calendars. It's happening on May 3rd in Omaha, as always. This year's format will be a bit different. Buffett, along with Greg and Ajit, will be directly answering your questions. I suggest you get the chance to really pick the brains of some of the greatest investing minds of our time. And, adding to the excitement, a brand new book will be released, titled Berkshire Hathaway, 60 Years. It's a fitting tribute to this incredible milestone, and I am sure it will be packed with invaluable insights and lessons learned over 6 decades of market-beating performance. So if you are able to make it to Omaha, it's an event you absolutely won't want to miss. For those who can't, we at Collin Investing will bring the most important information to you. And that brings us to the close of another in-shekel week in the markets. We've covered a lot of ground, from volatile market swings and concerning economic indicators to the actions of political figures and the timeless wisdom of Warren Buffett. I hope you found this deep dive valuable. Remember, at Collin Investing, we're dedicated to providing you with the analysis and context you need to make informed decisions in this ever-changing financial landscape. So, if you found this video helpful, please give it a like and, most importantly, subscribe to our channel. Your support helps us continue to create content that empowers you on your investment journey. And, of course, we want to hear from you. Share your thoughts, your questions, your perspectives in the comments below. Let's get a conversation going. I try to respond to every comment personally. Finally, don't forget to turn on those notifications. That way, you'll be the first to know when we release new videos, ensuring you stay ahead of the curve. Until next time, happy investing, and I look forward to seeing you in the comments.